Preeti ma'am for your kind words and Ketan sir. So, as we proceed to introduce Dr. Anup Shah, sir is a law graduate from Mumbai University and he is also a member of CA Institute very well. He has secured 19th rank All India in CA finals. Sir is also a PhD from Mumbai University on business restructuring strategies. He advises in M&A, international estate planning, migration strategies, international tax, foreign investments, capital market regulations. He has also contributed towards the various books, and he has co-authored and authored books on capital market regulations, wills, succession and family settlements, Law and Business edition published by BCAS, Income Tax Advisor. He has contributed over 250 articles to several publications and newspapers. He has been twice awarded a prize for the best feature in the BCA journal, awarded the Outstanding Research Contribution by University of Mumbai in 2016, and has also been awarded as the Outstanding Research Paper at the International Conference on Commerce and Management, Mumbai University from 2013 to 2018. Sir is an independent director in various listed and unlisted companies and also a member of International Taxation Committee of Chamber of Tax Consultants. Sir, we welcome you to us. I request Preeti ma'am and Ketan sir to present. Yeah, sir, Rahul sir also to present the memento to the speaker.
Good afternoon, friends, and thank you, Preeti Ben and Ketan Bhai, for very kind words of introduction. After a very general overview by Vishal, which was an excellent trailer to the movies which you will be seeing in depth over the next 2 days, let's get into specifics of a subject which Ketan Bhai rightly said is the smallest of act. FEMA 1999. Incidentally, FEMA and my CA and FEMA were around the same time. I cleared my CA in 98 and FEMA came in 98 but became effective 1 year later. So that point of time we had FERA, which was much more draconian compared to FEMA. But when I look at FEMA and I ask myself a question, have things liberalized so much? Answer is not fully. We are yet not as liberalized as we would have liked to be. I have been practicing FEMA for 26 years and I don't see things changing so drastically compared to what it was under FERA. So what I intend to do over the course of the next 1 hour is to take you through cross-bordering restructuring, looking at only the FEMA aspects. Of course, there'll be several tax and other implications, but I am looking at a very razor-sharp focus only on FEMA. And we're looking at 7 types of restructuring. There could be many more. I've narrowed it down to only 7. A foreign company acquiring an Indian company, one of the most popular modes of restructuring known as inbound acquisition. A foreign company merging into an Indian company, inbound merger, something which was also happening under the Companies Act. Vishal touched upon it in his example of Pine Labs merging into the Indian holding company. That's what we are looking at. Acquisition or transfer of profit share in an Indian LLP. You can even transfer shares in an Indian LLP. How would that happen? Indian companies acquiring foreign companies. We have the FEMA ODI rules 2022, which were notified 2 years ago. So Indian companies acquiring foreign companies, again, now very commonplace, not as unusual or unheard upon as 10 years ago. Indian companies merging into foreign companies. This is something which is very, very rare. I have seen probably only one case which is going on in the Companies Act, but it's something which is very rare. Merger of 2 Indian companies and shares being issued to non-residents, again very common. and exit of foreign investment or foreign PE funds. Time permitting, I'd like to cover everything. Otherwise, we'll cover whatever we could and then open the floor for questions if there are any. Inbound acquisitions could be done by methods too. One is a foreign direct investment, where money from abroad comes directly into the Indian company, hence foreign direct investment. That's the name. Or you take over shares where Indian promoters are selling shares to a foreign promoter or a foreign acquirer. That's the second method. First is primary, second is secondary. In the primary method of FDI, you could have 2 or 3 methods or sub-methods. First is a private placement, which is an Indian company making a placement to a foreign company. If it is a listed company making a private placement, it is known as a preferential issue. And second is indirect FDI, where one Indian company, which already has foreign direct investment, is used as a vehicle for acquiring another company. So you have Indian company 1, which has been funded from foreign funds, which is using those funds to make an acquisition into Indian company 2, known as downstream FDI or indirect FDI in common parlance. When we look at a takeover of shares, it could be a private deal that is off market, or it could be on market on the floor of a stock exchange like BSE and NSE. FDI, the whole regime underwent an overhaul in 2019. What we now have are the Foreign Exchange Management Non-Debt Instrument Rules 2019, which are notified by the Government of India. So now we have bifurcation. Anything which is capital account pertaining to investment in shares in India or abroad is notified by the Department of Economic Affairs, Government of India. Anything which are regulations to implement these rules are notified by the Reserve Bank of India. So the power to notify rules for capital instruments has been taken away from RBI and placed with the Finance Ministry. And they have come out with threshold-based definition. FDI in an unlisted company, or rather foreign investment in an unlisted company, would always be treated as FDI. Foreign investment in a listed company of 10% or more will always be FDI. Foreign investment of below 10% in a listed company would be treated as foreign portfolio investment. Now, when we talk of foreign portfolio investment, we should not confuse this with a foreign portfolio investor. A foreign portfolio investor is one who is registered with SEBI, which we earlier knew as an FII. So when you watch on CNBC FII investment, that is a SEBI registered foreign portfolio investor. But if you even have a foreigner who is buying shares of 9.99% or lower in a listed company, such investment would be treated as foreign portfolio investment, although the investor does not become an FPI. So it's a little bit of a dichotomy when I'm saying on one hand it is foreign portfolio investment, but in the same breath, he is not a foreign portfolio investor. He could be, he need not be a SEBI registered FPI. So that's the distinction which the NDI rules have placed. If I look at it on a graphical representation, foreign investment in unlisted company, always FDI, percentage is irrelevant. Foreign investment of 10% or more in a listed company, always FDI, even if by a SEBI registered foreign portfolio investor. So your threshold is the important thing. Person is not relevant. Even if it is a SEBI registered FPI, he can make an FDI. Foreign investment of less than 10% in a listed company, always FPI. Foreign portfolio investment, percentage is relevant. And if the foreign investment falls below 10% in a listed company, it remains an FDI. So once FDI, always FDI, percentage now does not matter. So you look at a horses for courses approach, when it would be FDI, when it would be foreign portfolio investment. FDI is prohibited in 7 sectors. No go. You cannot get FDI in these 7 sectors. Chit funds and nidhi, agricultural plantations. Now here there are some examples which are exceptions, like horticulture, floriculture, growing of crops of like mushrooms. Then it's permissible. Real estate business and TDR trading. A very, very important definition to know. Real estate business is prohibited. Real estate development is not prohibited. You can invest in Oberoi Realty, you can invest in Godrej Properties, but you cannot invest in a property which is buying and selling land or buying and selling TDR or buying and selling flats. The key is, are you doing a value addition after buying the land? If yes, you can get FDI. If no, you cannot get FDI. Gambling, lotteries and casinos. Delta Corp, the only listed company we have which is into gambling and casino in India. Can it get FDI? Answer is no. Because Delta Corp has floating casinos in Goa, it has a casino in Sikkim, it has a lottery kind of a business, it cannot get FDI. So that's a clear-cut no-go. Atomic energy, because of sensitive government concerns. Tobacco and related products, ITC cannot get FDI. Even though ITC does a host of other businesses, because it has tobacco, it cannot get FDI. Post the demerger of ITC hotels, they can get FDI in the hotel business, but not in the current business. Sectors not yet open to private sectors. Railways. Railways is something which is not yet open to private sectors. So you cannot, if you are in the railway business, which the government is, they cannot get FDI in that. So these are the 7 sectors where you cannot make a foreign cross-border investment by way of acquisition, by way of sale of shares, by way of fresh issue, total per bar on FDI. Now, very important to know, bar is on FDI, not on foreign portfolio investors buying it on the stock market. Let's look at this, real estate business. If there is a company which is listed on BSC, which is into trading of land, you can get a foreign portfolio investor to invest in it. Delta Corp, it has 28% of FPI shareholding because that is not FDI. That is being bought and sold on the stock market. ITC, it has over 49% foreign shareholding. It can be done because it is not FDI, it is foreign portfolio investors and NRI portfolio investors buying. So what you cannot do as FDI, you can do as portfolio investment. Valuation when you are acquiring shares under FEMA. Now look, please bear in mind, we are only looking at it from a FEMA perspective. I'm not looking at 50 CA, I'm not looking at 56.210, I'm not looking at Companies Act. We are only looking at it with a razor sharp focus of FEMA. If it is FDI, it must be at or above the fair market value. What is fair market value? Earlier we used to have the DCF method which was prescribed. Now RBI has said any internationally accepted pricing method. It could be DCF, it could be PE multiple, it could be NAV, it could be book value, it could be comparable company multiple. If it's a marketplace like Amazon, it could be gross value merchandise. Whatever is internationally acceptable, that's permissible. You need a CA or a merchant banker's valuation. Here CAs are yet allowed. Unlike 56.210 or Rule 11 UAE for 7B, you can get a CA's valuation. So that's something which should be looked at. If it is a fresh issue by a listed company, you have to look at SEBI preferential issue pricing guidelines. If sectoral caps are breached or if it is in a zone where FDI is taboo, is there a way out? You can look at investment from abroad on a non-repatriable basis. Schedule 4 of the FDI NDI rules permits non-repatriable basis investment even in sectors where FDI on a repatriable basis is not permissible. What does non-repatriable mean? Only dividend and interest on the investment can be sent back. Principal and capital gains have to be credited to the NRO account. They cannot be repatriated freely. Investment in such cases, interestingly, is treated as domestic at par with resident investment. So if it is a non-repatriable investment under Schedule 4, it's a domestic investment. Here there are some sectors which are prohibited even for Schedule 4. Nidhi, chit fund, plantations, farmhouses, dealing in TDRs and real estate business. The investment can be in listed, unlisted shares, LLP capital, partnership capital or sole proprietary form. What is the implication of a non-repatriable investment? It's allowed only for NRIs and OCI card holders and their entities. So entities controlled and managed by NRIs and OCIs are eligible for Schedule 4 non-repatriable investment. No pricing norms, no valuation formulas like Schedule 1. No filings for FDI single master form because this is not FDI, this is domestic. Not counted for direct or indirect foreign investment limits. Can be in multi-brand retailing, tobacco, telecom. No bar to investing in gambling, lottery sectors which are not open to private sector. All of that is permissible. subject to the exception which we looked at in the previous slide. Now, if it's a secondary market deal, that is a takeover by a foreign entity. So you have a foreign buyer who is acquiring shares from Indian stroke foreign shareholders. That would be treated as a secondary market deal, and the Indian company, nothing changes at the company level. Now here the type of transactions allowed is an on-market deal. Here you could have buyers who are foreign portfolio investors, qualified institutional buyers, non-resident Indians, and overseas citizens of India. These are the only 4 foreign entities who can buy shares from the stock market. A foreigner who is not an NRI or an OCI card holder, or a foreign company who is not a foreign portfolio investor or a QIB cannot buy shares on the Indian stock markets. They have to buy it on an off-market basis or a private arrangement if it's a listed share. Unlisted shares, any foreign entity could buy. Now in this, you also have one new restriction which came in during COVID, that is called land border country restriction. If you are an entity or a buyer located in a country which shares a land border with India, this was predominantly done to thwart Chinese takeovers of Indian companies during COVID. But all countries which share a land border with India, including Pakistan, Nepal, and China, if you are an entity from these countries, you would need prior permission of the government of India. Their Ministry of Home Affairs would also look at a security clearance, and only if that clearance comes through, you can go ahead with the transaction. I remember during the COVID times, we were doing a transaction for a renewable energy company where China Light, the Hong Kong subsidiary of China Light, was buying out the renewable energy. And since the ultimate beneficial ownership was in China, although this was a Hong Kong based company, the matter went for approval to the government of India, and it ended up taking a huge amount of time because of this, and the deal itself went into jeopardy. Ultimately it did go through, but then this is something which needs to be borne in mind when you're doing transactions involving land border countries. Now, what are the pricing guidelines when you look at transfer of shares? If the seller is a person resident outside India other than an NRI OCI, and the buyer is any non-resident, including an NRI OCI, then it's an automatic route of RBI, no pricing guidelines. You do it at whatever transaction you want to do, subject to keep in mind your income tax and other laws. As I mentioned, I'm only looking at FEMA. Here, if the buyer is a foreign portfolio investor, not investment, investor registered with SEBI, he can buy only 9.99% maximum shareholding in one company. So one FPI maximum threshold is 9.99%. If he ends up buying 10% or more, he must divest the excess, or the entire shareholding will become FDI. And then the whole FDI valuation, reporting, and other guidelines will follow. So very important, he's given a time period of a few working trading days within which the FPI must divest the excess shareholding to fall below 9.99 or lower. Similarly, if the seller is an NRI OCI, he can sell it to any buyer. If the buyer is an NRI OCI, and here the limit is 5% or more. So in FPI it is 10% or more. Here is 5% or more. If you end up buying as an NRI, you need to divest the excess. Again, automatic route, no pricing guidelines. You are free to do it at any transaction price. If it is a resident selling to a non-resident, as often happens when an Indian company is bought out by a foreign company, here you have pricing guidelines. The minimum price must be the fair market value as per any internationally accepted pricing methodology. We looked at what that internationally accepted pricing method could be. But if the buyer is a non-resident buying under Schedule 4, non-repatriable, resident seller, non-repatriable NRI buyer, domestic to domestic, no pricing guidelines applicable. Reverse case of a non-resident selling to a resident. Non-resident seller, resident buyer. Here there is a maximum price. You cannot buy above the maximum fair market value of the company. Simple logic. When Forex is coming into company, minimum FMV. When Forex is going out of the country, maximum FMV. So these are the pricing guidelines which need to be borne in mind. In addition, the acquisition by a non-resident must comply with the FDI sectoral cap, so ensure it is not in tobacco. If it is in FM radio, the maximum cap is 49%, plus you need government approval, and all other conditions applicable under the Ministry of Information Broadcasting would be applicable in such a case. So if Radio Mirchi, which is a listed company, is being acquired, only 49% could be acquired with government approval, with MIB conditions to be fulfilled. And land border countries, we discussed it a couple of minutes ago. Listed company takeover, follow the SEBI pricing guidelines which are there on the floor of the exchange, not applicable for buybacks, delisting or open offers. So a few years ago, there was an open offer for a listed company by a foreign acquirer. In such a case, they don't have to follow the pricing guidelines because then SEBI has blessed it and it is going under the open offer process. If it is a buyback of a foreign person's shareholding by an Indian company, Capgemini did a buyback of the promoter of UK, they does not need to follow the pricing guidelines because then it is under the court approved process. Unlisted company, we looked at, it should be maximum FMV or minimum FMV. Now, recently, ever since Tata Docomo, I don't know how many of us remember that, there was an entity of Japan which had invested in Tata Teleservices, and the Tata Sons group decided to give them an exit. Now, somehow the price which was agreed upon was lower than the price which was possible under the FEMA pricing guidelines. So the matter went to the International Court in London for arbitration, and ICC London gave a verdict in favor of NTT for buying out by Tata Sons at a price higher than what was permissible under the FEMA pricing guidelines. They approached Delhi High Court and they said, look here, we've got this award which is a downside protection award which Docomo is getting under the shareholders agreement. Hence, we will override your FEMA pricing guidelines. RBI obviously did not agree to it, but the Delhi High Court agreed in favor of NTT and Tata Sons, saying this is a downside protection. You can override your FEMA pricing guidelines, and it did permit the pricing to go through at a higher valuation. Similar, another decision was Delhi High Court in City Cruise versus Unitech, where a similar transaction took place. FEMA pricing guidelines not being adhered to, was said it's okay because it's under an arbitration award, which is more in the nature of downside protection. This second decision of Delhi High Court was referred to by the Supreme Court in Vijay Karya's case. And this is a very interesting decision. Here, there was a sale taking place at a valuation which was much lower than FEMA pricing guidelines. And FEMA pricing guidelines required a certain price. This was taking place at a lower price. The Supreme Court said, under FERA, section 47A said any transaction which was not in accordance with FERA was void ab initio. You could not do the transaction. FEMA does not have such a provision like 47A of FERA. Therefore, you can do the transaction even if it violates FEMA. You may approach RBI for post facto approval, or you may approach RBI for compounding of violation, or you may approach RBI for paying penalty. That's a separate matter. The transaction can go through even if pricing guidelines are not met. So these three decisions laid down a very important framework. NTT Docomo Delhi High Court, Unitech versus City Cruise Delhi High Court, and Vijay Karya Supreme Court. Now, when we do transactions, often there is a payout or an earn-out mechanism where the seller says, look here, I want 100 because my company is projected to do X. As Vishal was giving you an example that, they were always better and better prospects. Buyer says, all this is on paper, I don't buy your thing. And there are so many other liabilities. What if they fructify? So then they come out with an earn-out formula. Okay, fine, you keep certain percentage in escrow. As and when time goes and things improve, if I deliver as I have promised, then you have to pay me. So RBI now allows you expressly deferred consideration up to 25% can be placed in escrow for a maximum period of 18 months from the date of SPA. So you can't do it for 24 months or 36 months. It is maximum 18 months. Seller can also give an indemnity for a maximum of 18 months if full consideration paid by the non-resident buyer. Total consideration paid must be in accordance with the pricing guidelines. And if that is so, you have an automatic permission of deferring up to 25%. What if you want to defer more, or if you want to defer beyond 18 months, you need prior permission of RBI specifically. These are all general permissions under the rules. If you want to do anything out of the box, go to RBI for prior permission. Escrow may or may not be mandatory. You can do it private. ODI also now it is allowed. Yeah. When we come to ODI, I'll touch upon that. Now, put and call options, something which was very popular a few years ago and full of controversy. Now the controversies have gone off, but nevertheless they are popular. When you get an FDI from a foreign investor, he often says, what if the company cannot give me an exit by way of an IPO or liquidation? Then in such a case, I want an option that the promoter will buy me out at the end of the period. So you have to give me a put option. I can put my shares on you and you have to buy me out. This is a put and call option. Now they are expressly permitted under the FEMA rules. Minimum 1 year lock-in. So the seller, the foreign investor, has to be locked in for 1 year. Then he can exercise his option. No assured returns. You can't say I'll get a guaranteed IRR of 15%. You can say I'll get a guaranteed IRR of 15% subject to the then prevailing FEMA pricing guidelines. If FEMA allows you 14, it is 14. If it is 15, you cannot have a guaranteed IRR. And exit price must be as per FEMA pricing, fair valuation. Allowed if it is there in the terms of the agreement. City craze we already dealt with, so I'm not going to go into again. Downstream investment. Now you have a foreign company which has 76% investment in an Indian company known as first level Indian company. First level Indian company becomes my vehicle for acquiring second level Indian company. This investment by first level into second level is known as indirect FDI or downstream. Let me give you a practical example which will drive home this point. Maruti Suzuki India Limited. Everybody knows of Maruti Suzuki. It has got over 51% foreign shareholding from Suzuki of Japan. It is known as a foreign owned and controlled company. Now if Maruti Suzuki wants to make investment in say another small auto company, the investment from Maruti into that second company would be treated as indirect FDI. What is the meaning? Owned and controlled. If it is owned 50% plus by a non-resident and or controlled by a non-resident, it is treated as a foreign owned and controlled company, what we call in FEMA as FOCC. Ownership 50% plus of the capital, it should be equity, CCD, CCPS. Control, what is the definition of control? Slightly different from the one we find under the takeover code. Right to appoint a majority of directors, control management or policy decisions, including by virtue of shareholder agreements. So basically if you have majority board rights, if you have veto powers under the shareholders agreement, which empower you to control, here it becomes a very thin line as the Securities Appellate Tribunal in Shubham Ventures versus SEBI has looked at. Would veto rights necessarily mean control? Not always. Do you have the right to drive the train or just pull the chain? If I can just pull the chain, it need not be control. If I can actually be in the driver's seat, I have control. So are my affirmative, are my protection rights only downside protection rights, or do I actually have the right to drive the company? That's a thin line to look at. Second level Indian company getting the investment would be treated as indirect FDI. Prominent Indian FOCCs, Maruti, Gillette, Hindustan Unilever, Bata. Now, a few years ago, AstraZeneca, listed Indian company, it has 75% FDI. Any investment by it in a brownfield pharma company beyond 74% needs government approval. So now since this is 75, it is doing an indirect FDI, it would need government approval. What are the important restrictions? FOCC must use funds from abroad or internal accruals for making the acquisition. It cannot borrow from India and make acquisition. So you cannot have an FOCC borrowing by raising debentures or loans from an Indian bank and making a downstream. Either it uses profit and loss balance or general reserve balance, or it gets fresh FDI from abroad. One of the two it can do. Can FOCC pay consideration other than in cash? This is something which is not dealt with under FEMA. But an interesting scenario recently I saw again in Maruti Suzuki. It acquired 100% shareholding in a private company owned by Suzuki Motors Japan. The consideration for the same was paid by Maruti Suzuki, making a preferential issue of its shares to Suzuki Motors Corporation Japan, and not by paying cash to the seller. So instead of paying cash, it issued more shares of the listed company to its parent. So now what happened is that the second company also came under Maruti, and SMC Japan owns Maruti, its shareholding went up, and now Maruti Suzuki is also owning the second level company. So this is an example of indirect FDI by consideration other than cash. The second level company must comply with the attendant conditions, sectoral caps. You can't do indirectly what you cannot do directly. Simple rule under FEMA, what you cannot do directly, you cannot do indirectly. If I cannot invest in a tobacco company, by this I cannot invest in a second layer tobacco company. FDI linked performance conditions need to be fulfilled because it is actually indirect FDI. Valuation, very important. You must follow the valuation guidelines even for the level 1 to level 2. I have seen many companies falling foul of this condition. They forget. They look at it, this is Indian to Indian. It is not Indian to Indian. It is indirect FDI to Indian. And you must have a board resolution approving the indirect FDI, a shareholders agreement. The FOCC, that is the first level company, is responsible for compliance with FEMA rules. It has to notify its downstream investment to RBI in Form DI. Also, file this on the Foreign Investment Facilitation Portal in fifp.gov.in within 30 days. Compliance must be mentioned in the director's report. The director's report under 134D of the Companies Act must mention compliance with all these conditions, and very important as auditors for all of us. You need a certificate to this effect. If it is qualified that the company has not complied with, the auditor is supposed to send this to the regional office of the RBI. Not important that you just bring it out in your audit report. Send the qualified report to RBI, or else the auditor will be in problem. And must this be only in the year of direct investment or every year? My view is better do it every year. Companies like Maruti and HUL are doing it year on year. Even if they have made an investment 4 years ago, till the investment continues, the auditor is giving a certificate and it is being mentioned in the director's report every year. So better be safe than sorry. Now let's look at inbound mergers. Foreign company is the transferor company merging into Indian company. Foreign company goes out of existence, and Indian company as consideration will issue shares to the erstwhile foreign shareholders of the foreign company. Under the Companies Act, this was possible both under the 1956 Act and again is now expressly permissible under Section 234 of the Companies Act. Rule 25A of the Companies Amalgamation and Arrangement Rules 2016 also expressly provide for a cross-border merger. NCLT permission is required for this, and you would also need permission of the High Court of the foreign company where the company is located. RBI has now issued express regulations called the Cross-Border Merger Regulations in 2018, which permits such an inbound merger. RBI calls it an inbound merger because the surviving company is an Indian company. It covers merger, amalgamation or any arrangement, thus foreign demerger will also be permissible. So you could have a foreign company which is demerging its undertaking into an Indian company. RBI permission not required specifically if you fulfill the conditions maintained in the regulations. What are the important regulations under the inbound merger rule? Follow the pricing guidelines, sectoral caps, reporting. Now the foreign office will become a branch office of the Indian company because the company has gone out of existence, but the undertaking is yet there. So the foreign entity becomes a foreign branch or an office of the Indian company. Borrowings which were made by the foreign company will now become those of the Indian company. So you will have an Indian company which is borrowed abroad. If they are in conformity with ECB regulations, fine. If not, you are given a period of 2 years to ensure they become in line with Indian ECB regulations. The foreign assets which you now end up owning, if you are permitted to hold under FEMA, fine. If not, you are given a period of 2 years to dispose them of. Valuation Indian company must be done by Indian valuers, foreign company required to be done by a foreign chartered accountant or a merchant banker or a securities valuer registered in those locations. If merger as per these regulations deemed approval by RBI, and you need a compliance certificate by the managing director or the practicing company secretary of the company who will say that this has been complied with, and that certificate is to be given to NCLT. Only after that NCLT will approve the foreign merger. Now, interestingly, FEMA regulations allow foreign demergers, but Companies Act only talks of mergers. Therefore, the question arises, can you have a foreign cross-border demerger under the Companies Act 234 read with Rule 25A? My view is yes. Merger is used more as a broad term. It should cover demerger also. But if I were to do nitpicking, no, there is no express provision for demerger. Few years ago, under the Companies Act 1956, Keynes Australia demerged their Indian oil fields into Keynes India Limited. That was done under the Companies Act 1956. But under NCLT rules, no express provision. Also, you need to bear in mind that for the foreign inbound merger, the company should be from a jurisdiction which is A, FATF compliant, so FATF compliant. It must be compliant with the Financial Action Task Force. It must not be from a jurisdiction which is on the grey list or blacklist from money laundering perspective. And it must be from a country whose market regulator like SEBI or central bank like RBI has entered into a global memorandum of understanding. As things stand today, there are only two countries, Iran and North Korea, which are on the negative list of FATF. So you cannot have an Iranian company merging into an Indian company or a North Korean company merging with an Indian company. Reverse flipping, coming home as we call it, or Ghar Wapsi. So you have a lot of startups who first went abroad, domiciled abroad, and now they are coming back to India. What is the reason? They want to relocate headquarters to India and a precursor to an IPO in India. There are two main strategies which are being used for reverse flipping: inbound merger, inbound acquisition by swap of shares. Merger of the foreign holding company into the Indian subsidiary, cancel the shares held by the foreign company in the Indian company, and issue shares from the Indian company to shareholders of foreign company. Example, Pine Labs Singapore merging into its Indian subsidiary, and the Indian merged entity then has decided to file an IPO or is filing a confidential DRHP with SEBI. They are going in for an IPO. Pine Labs is one of the largest payment settlement aggregators in India. Stock swap, founders and PE funds sell shares in the foreign company to the Indian company, and in return are issued shares in the Indian company. So the foreign guys are selling their shares in the foreign company to the Indian company, and the Indian company is issuing shares to the foreign guys. Example, PhonePe Singapore swapped with Indian company, so that now it is the PhonePe India which is the parent and PhonePe Singapore is the subsidiary, and now PhonePe India will go in for IPO, etc. Other FEMA considerations besides the host of tax issues to be looked at: Press Note 3 considerations, land border country we spoke about. So if the sellers in this case of PhonePe Singapore were say from Hong Kong or China, you would need prior permission of the government of India because you are doing a stock swap of a land border company. What if the surviving Indian entity post-merger is in a sector where FDI is restricted or prohibited, say in multi-brand retail trading or in tobacco? Then you would need prior permission, or it may not be allowed altogether if it is in an FDI taboo zone. So these are factors which need to be looked at. Most of these flippings are taking place in the e-commerce sector or in the fintech sector where there are no sectoral caps. So therefore it's becoming easy to do the flipping. Acquisition of Indian LLPs, with so much business now being done through LLP. Can you buy and sell LLPs? Answer is yes. The LLP Act 2008 does permit you acquisition of interest in an LLP. That's expressly provided. Does FEMA regulations permit it? Answer is yes. If you look at Schedule 6, persons resident outside India can acquire profit share in LLP by way of transfer. There are some restrictions as to who cannot buy. Citizen of Pakistan or Bangladesh, foreign portfolio investor registered with SEBI or a foreign venture capital investor registered with SEBI cannot invest in an LLP. So that's a strict no-go. Not in sectors where 100% FDI not allowed. FM radio maximum FDI is 49%. So you cannot have an LLP which in FM radio, and that LLP cannot get foreign investment. Not in sectors where FDI linked performance conditions are specified. Defense, multi-brand retail trading, these are sectors which have performance linked conditions. You need to do this, you need to do that. If it is in such a sector, you cannot get foreign investment. What is the valuation? Again, fair price of the profit share as per any internationally accepted pricing methodology. This has become standard across FEMA. Everywhere it is internationally accepted pricing methodology. Minimum if it is from foreign investor, maximum if it is to foreign investor. So this remains constant whether it is inbound FDI in a company LLP or outbound FDI in a company. So we looked at inbound, let's look at outbound. Indian companies acquiring abroad. Here you have three regulatory provisions which we need to look at. You have the FEMA Overseas Investment Rules 2022 notified by the central government, Ministry of Finance, Department of Economic Affairs, administered by RBI. So these are notified by Finance Ministry, administered by RBI. Overseas Investment Regulations 2022 notified and administered by RBI, and Overseas Investment Master Direction of 2022 again notified and regulated by RBI. So regulatory authority remains RBI, but the main overarching rule is from the Ministry of Finance. Indian entities can invest abroad. Here it's a very broad term. Indian entity covers Indian company, LLP and partnership firm. All three are eligible to make an overseas investment. What is the limit? Up to 400% of the net worth of the Indian entity as per the last audited balance sheet. So 4x of your net worth as per the audited balance sheet becomes the maximum you can acquire on an automatic permission. If you want to cross that, you need specific permission from RBI. You can use ECBs of foreign exchange, buy foreign exchange for making the acquisition, and you need to carry out a valuation if you are acquiring an existing company. Here again, just as we had FDI and foreign portfolio investment, we have ODI and overseas portfolio investment. Rules remain more or less the same. Unlisted foreign company, with or without control, whether you're buying one share or 100%, it is always ODI, that is overseas direct investment, never overseas portfolio investment. Control means right to board seats, shareholders agreement, management, or in either case, getting you control. Listed foreign company, where if you are buying 9.99% or lower without control, it will always be OPI and never ODI. Listed foreign company of 9.99% or lower, but you have control. You have a board seat, you have veto rights, you have affirmative votes. In such a case, it will become ODI. It does not remain OPI, it becomes ODI. If control lost, it remains ODI. Once ODI, always ODI. Just as we had once FDI, always FDI, here we have once ODI, always ODI. And if it's a listed company of 10% or more, with or without control, it will always be ODI. Even if some shares are sold and your stake falls to say 8%, you continue to remain overseas direct investment. What is permissible for ODI? Investment outside India shall be in a bona fide business activity. Now, prior to 22, they never defined what was bona fide business activity. Now they have said it must be permissible both under Indian and foreign laws. Let's look at few examples. Gambling. It's expressly a legal activity in UK. Ladbrokes London is one of the largest betting firms in the world. You could bet on the Euro Cup officially in London. And Ladbrokes is a company which runs betting online and offline. Indian company cannot invest in Ladbrokes because that is an activity which, though permissible in UK, is not permissible in India. So that's out. What if it's a cannabis dispensary? Weed, cannabis, these are activities which are officially permissible in several states in USA. You could have a cannabis dispensary in USA and it is not illegal, but it's treated as a recreational drug. But in India, under the Narcotic Drugs and Psychotropic Substances Act, it is an illegal, impermissible activity. So an Indian company, an Indian pharma company cannot invest in a cannabis dispensary in UK or US or France, because that is something which, though permissible abroad, is not permissible in India. Real estate activity, again a question mark. If it is construction, development, no problem. Go ahead. Lodas have invested in several real estate properties in London and they are doing a fabulous job, no issue. But if it is buying and selling of real estate without any value addition, that's not permissible. What if it's a company which is buying property and leasing it out? Is that permissible? Now here you have a very interesting scenario. When we look at it from an FDI perspective, the NDI rules expressly provide that you can get foreign investment in an Indian company which buys property and leases it out. The same wordings are not there in the outbound investment regime. So can an Indian company invest in a company which buys property and leases it out? No express provision. It's a question mark. What about hotels, homestays, villas, hostels, PG accommodation, Airbnb? What if a company is doing all of this? In my view, it's not real estate business. It's in the hospitality sector. You should be possible to make an overseas investment in such companies. Land aggregation services, like we have in India, land aggregators. What if it's a land aggregator? That would be treated as a real estate business. So I don't think you would be permitted to make an investment in a land aggregator or a land facilitator who is merely buying different parcels of land and then selling it as a block to a larger company. Gambling we looked at, but if it is gaming, something like Dream 11, which we are all very popularly aware of. There's a foreign company, fantasy leagues started from US and came into India. It's not that India invented them. Baseball and American soccer always had fantasy leagues, which then moved on to the English Premier League and other countries and came to India as cricket. Can an Indian company invest in a fantasy league abroad? Answer is it gaming or is it gambling? And the Supreme Court in Chambugarwala has come out with a very clear threshold right back in 1957. Is there an element of luck which is more than element of skill? Then it is gambling. If the element of skill is more than the element of luck, it is gaming. So you need to see, is it gaming or is it gambling? Is it luck or is it skill? Depending on this gold stone, you need to decide whether you are permitted to make an investment abroad in a gaming company or no. Madras High Court in the case of online rummy has said it is a game of skill, not a game of luck. Online poker, Madras High Court has said is a game of skill, not a game of luck. So what is it? If I say, is it going to rain today? That is a game of luck. That it may or may not rain. Even though I may be a very good weather forecaster, but yet my skill element is very less. It's all based on the heavens abroad. So what is more, skill or luck? That will decide whether you can invest more in a gaming versus a gambling. Startups. Now here the overseas investment rules come out with this new provision. You cannot invest in startups abroad out of borrowed funds. What is the meaning of startups? They have not given. When we look at it from an Indian perspective, you have the DPIIT, Ministry of Commerce, which certifies what is a startup. There's no such certification authority abroad. USA, anything could be a startup. I could be a company which is 10 years old and yet be called a startup. So what do you mean by a startup? Now that causes a big question mark because I don't have the flexibility of using borrowed funds for investing in a startup. I may think this is not a startup, but what if Reserve Bank says, no, it is a startup? So this is something where there is a gray area when we are making an outbound acquisition. Financial services sector, I'm investing in a broker abroad, mutual fund abroad, pension fund abroad, insurance agent abroad. Here there is a separate set of activity and separate set of rules. What is financial services was never defined. The 2022 rules came out with a definition. If it is an activity which, if it was carried out in India, would be regulated by SEBI, RBI or IRDA, then it would be treated as a financial services activity. Or if it was an activity which required registration in India with SEBI, RBI or IRDA, it would be treated as a financial services activity. Question which comes to mind, would the 50-50 principle NBFC test, which we all as auditors are aware of under the 1999 press release, would that be applicable to a foreign company? So if there is a foreign company where dividend income and shares are more than 50% of the gross income and gross total asset block, would it be treated as a deemed NBFC, and hence do I have to follow the financial service regulation requirements? This is a question which no express clarity. You need to take a considered view on that. If the Indian acquirer is also in a financial services and it wants to make an acquisition in the financial services business, so an Edelweiss wanting to invest in a broking company abroad, the Indian entity must have net profit in preceding 3 financial years. It must be registered with an Indian FSS regulator, SEBI, RBI or IRDA, and it should have received approval both from the Indian regulator and the foreign regulator, as the case may be. It may be that the foreign regulator does not give permission, that is, you don't need permission, then at least you need it from your Indian parent, which is SEBI. If these 3 conditions are satisfied, you have automatic RBI permission or you need express provision. What if it is an acquisition by an Indian company not engaged in financial services? So Indian entity which is into, say, manufacturing of toothpaste decides to diversify by investing abroad in a broking entity. Then only condition which required to be fulfilled is that the Indian entity should have net profit of 3 years in the preceding financial years. Other than that, no approval, no registration required with Indian regulator. Can you sell the ODI which you have bought? Of course, because everybody is here only to make money out of investment. You did not just make it for posterity. So you can sell it to a non-resident abroad, or you can even sell it to another Indian company. So one Indian company having made investment abroad can sell it to another Indian entity. If it is sold to another Indian entity, the second guy must be eligible to buy 4x limits, all provisions apply to him. Seller must have held for a minimum of 1 year. Valuation rules will apply. It is fair market value as per any internationally accepted pricing methodology, and that is the minimum sale price which you need to look at. Now here, when we look at internationally accepted pricing methodology, Reserve Bank has said authorized dealer banks must put in place board approved policy for valuation methodology. Now this is a little, I won't say confusing, but I would say not in good spirit, because every bank will now come up with a different valuation methodology as approved by their board. Citibank will look at one, Kotak would look at one, State Bank would look at one, a smaller PSU bank would look at one. Till now, I don't think they have come up with, each bank has not come up with it, and they're going by the CS certificate. But going forward, when different bank boards start coming out with different valuation, you will have to value as per the policy of the AD bank where you are dealing with. And if you are dealing with different AD banks, you may have different policies. Valuation not needed in certain cases if the transfer is arising on account of merger, demerger. So if it's an inbound acquisition or an outbound acquisition, you don't need to look at the valuation methodology. Liquidation of the foreign company and the price is approved by a court in India or abroad, you don't need to look at the valuation methodology. Or if it is acquisition of a listed company and its price is traded on BSE, NSE, then again you don't need to look at the valuation methodology. The valuation certificate should be maximum 6 months old. So you can go back only 6 months. Beyond that, you would need a fresh valuation certificate. Stock swap, very popular amongst the software companies. Indian company like Infosys, Wipro, TCS, acquiring a smaller foreign company abroad, buying the shares. Instead of paying cash for the shares, they issue their own shares to the foreign shareholders. So it is treated as ODI with FDI. The blue leg is ODI, the green leg is FDI. So Indian company issues its shares in return for shares of foreign company. It's automatic on an outbound basis. Valuation required for both ODI leg and inbound leg. And it should be in a sector where FDI is permissible, because now you have, if you go back, now you have foreign investment coming into the Indian company. So again, it cannot be in a sector which is taboo for FDI. It cannot be in a sector which has restrictions for FDI. All of that needs to be borne in mind. Outbound mergers, reverse of inbound mergers. Indian company merging into foreign company. Survivor is the foreign company. Indian company goes out of existence. Indian shareholders of the erstwhile Indian company are now being issued shares by the foreign company. Was not permissible under the Companies Act 1956, expressly permissible under Companies Act Section 234 read with Rule 25A. Indian company would now become a branch office of the foreign company. So now you will have a very interesting scenario where the Indian entity is a branch or a permanent establishment of the foreign company. Borrowings of Indian company will have to be repaid by the foreign company. Post-merger entity shall not acquire any liability to an Indian lender in rupees which is not in accordance with FEMA, and foreign company must not acquire any asset in India which is not in accordance with FEMA, or it must divest the same. And it has a period of 2 years within which it can set its house in order. This is a simple one when two Indian companies are undergoing merger, demerger, and one of them has foreign shareholders. The transferee entity can issue shares to the foreign shareholders of the transferor entity, provided the scheme has been approved by NCLT. Percentage of shareholding in the transferee is within sectoral caps or as per central government approval, and it is not in an FDI prohibited sector. For instance, again, look at the gambling or the casino or the tobacco companies. You can't have merger of ITC or Delta Corp because they cannot issue shares on merger to the foreign shareholders. Indian company can make a bonus issue of preference shares or debentures to foreign shareholders. Now, this is something which is permissible. It is capitalization of your reserves. Instead of declaring dividend, you issue bonus preference shares or bonus debentures under a scheme of arrangement approved by NCLT, Hindustan Unilever, NTPC, Blue Dart, ZTV. All these had done this very popular. Even Britannia has issued bonus NCDs, where they have issued these debentures which over a period of 3 years will be redeemed gradually, plus you get interest, and this is done by debiting the general reserve and by going to NCLT for a specific approval. Lastly, we'll look at exit of foreign investment or foreign PE funds. 3 broad options. There could be many more. I'm only looking at a very broad scenario: buyback of shares, reduction of capital, or buyout by a promoter. Buyback is under the Companies Act. You have the limits of 25% of equity capital and free reserves, or 25% of equity capital per financial year. This is under the Companies Act. What is applicable even if the shareholder tendering his shares is a foreign investor. You can use free reserves and share premium for buying out the investor. Automatic route of RBI. You don't need specific permission if the shareholder is a non-resident. Pricing guidelines we looked at. If it is under a listed company regime, such as Reliance buying back its shares, you need to follow the SEBI pricing guidelines. If it's an unlisted company like Capgemini, it has to follow internationally accepted pricing methodology. Reporting would be done in form FCTRS with the authorized dealer, and you need to file all the forms for that. Reduction of capital, instead of buyback being an in-house process, reduction is somewhere where you go to the NCLT for a scheme of arrangement and you get a specific permission. This would not be treated as a buyback. This is a scheme of arrangement. What was earlier Section 100 of the Companies Act is now Section 66 of the Companies Act 2013. Shares cancelled and consideration paid. You can even have selective reduction. Now here, this is something very useful when you're buying out just one shareholder. So in cases like Reckitt Benckiser, Jaicorp, Elpro International, only one shareholder block was bought out and reduced. The others continued. That is possible under a scheme of reduction, and automatic route of RBI and pricing guidelines applicable even under this. Buyout of private equity by promoters, we looked at the put and call options, and I've covered that in detail. Valuation is key, not higher than fair market value in case of foreign exchange flowing abroad. Lastly, while we looked at FEMA, do not forget these. These are the blocks which Vishal dealt with in his opening slide: Companies Act, income tax and tax treaties, SEBI takeover regulations when you're dealing with takeovers in the listed company space. Similarly, if you're dealing with takeovers of an NBFC, you need to follow the NBFC directions of change of control, stamp duty, competition laws, foreign laws and foreign courts if you're looking at merger of a foreign company into Indian or Indian company into foreign. Laws of foreign stock exchange regulators, SEC of US, Monetary Authority of Singapore, and accounting standards. All of this would have an impact in our cross-border restructuring. While we looked at FEMA alone, FEMA is never an island and it comes with a group of other laws. So please do pay heed to this. Thank you, friends, for a patient hearing. If we have some questions, I'll be happy to take. Yeah.
Earlier regime were described as a concept of OCB, which is now erstwhile OCB.
Yeah.
Then in 2003, the RBI banned it. So now how the erstwhile OCB stand today as on?
So erstwhile OCB making an FDI, it now comes in as a foreign company. So they can do that. There is a provision expressly in the NDI rules that if an erstwhile OCB wants to make a foreign direct investment, it can do so.
And does the condition of 60% need
No,
to be
no, no. That is gone. Gone forever.
introduction of FEMA?
Yeah, yeah, it's gone. So round tripping is Indian money going abroad as FDI and coming back as ODI and coming back it as FDI. Now this was frowned upon very extensively, but when the Overseas Investment Rules 2022 came in, they have now come in with an express provision that you can have round tripping if the foreign company has only one level of Indian company. So if there is foreign company and Indian company, you can have round tripping going abroad. But if it is more than that, that's not permissible. So to some extent, it has been liberalized. Under the pre-2022 regime, they had also liberalized it by saying you come to RBI for specific dispensation.
Sir, for swap example that you mentioned, so in case of where there is a swap including FDI and ODI, so under FDI, an Indian company is permitted to issue shares only against swap of equity instruments. So does that mean that the transfer, the person to whom I am issuing shares, so should swap the shares of an Indian company against the shares of an Indian company and not shares of a foreign company?
No, foreign company is permissible.
Foreign company would be
Yeah,
possible, right?
yeah.
Sorry, but in OCBs they have said that they have to obtain a permission, not permission, but they have to refer to RBI and that RBI has to confirm that they are not in negative.
Only if they are not in negative list.
So that list is published or it is on a specific?
Or if they have come in that list, then you would know it as an OCB. Otherwise, you don't need to go to RBI for every case. Yeah.
I don't have to.
No, no.
How are convertible?
They will inform me that I'm in.
That was done in 2000. Now.
How are convertible instruments dealt with from an ODI perspective vis-a-vis the valuation? Because in NDI you have an express provision saying it has to be upfront. From an ODI perspective, at what stage do you get the valuation report? Is it on issuance, conversion?
Today, because they would be treated as capital. They are treated as capital instruments. So you would have to treat them as capital instruments. So anything which is equity, compulsorily convertible debt or compulsorily convertible preference is treated as capital. If it is optionally convertible preference or debt, it is treated as debt and not treated as ODI. So then that would go in the overseas investment regime under the debt regulations, but not as ODI. So you would today have to value it as quasi-equity. Thank you.
Thank you so much, Anup sir. We, on behalf of WIRC, express my gratitude for the outstanding technical session you have conducted on cross-border deals. And definitely with these sessions and the insights, we'll be able to delve deeper into the concept. And this is a very complex topic, and so thanks a lot for having an interactive session with the attendees. Thank you so much for your time, effort, and sharing your experience with us.
Good afternoon. We'll quickly start with the next session. We are running late, so we'll actually curtail a little bit of lunch so that all the speakers can get enough time to speak. So I'll quickly invite Girish sir to kindly come on the dais so that we can start with his presentation. I'll also request Bhavna. So Girish sir will be dealing with... Bhavna, you'll introduce Girish sir? Yeah.
So since we are already running a bit late according to the schedule, I would quickly move on to introduce our next faculty for the session, specific considerations for M&A deal, listed versus unlisted target. I welcome Sir Girish Banwari. Sir has over 29 years of consulting experience. Sir is the founder of Transaction Square, a tax, regulatory and business advisory firm. He, prior to his entrepreneurial venture, he had a 13-year stint with KPMG. He was the national leader for the tax. He has advised many large multinationals and India promoter companies on various tax and regulatory issues.